everyone, and a very warm welcome to the webinar this morning. This is the first in a new series of webinars exploring tax issues that affect businesses, so we're very happy that you've joined us today. My name's Amy Jack, and I'm joined today by my colleague Jonathan Hornby, who's a partner in our corporate tax team. And for this morning's webinar, Jonathan has selected 3 hot topics which are likely to require your attention as part of the annual tax return process. And it's particularly timely as many groups are now starting to focus on year-end compliance matters. So specifically, we're going to be looking at the corporate interest restriction, which has received lots of attention from HMRC this year. We're also looking at the new merged R&D tax credit scheme. And finally, we'll talk about some additional reporting requirements relating to the rules on hybrid mismatches. But just before we get started, I've got a couple of housekeeping points for you. This webinar is being recorded and it will be available on our website and will be kept for up to a year. But just to reassure you that no attendees can be seen or heard. We would love you to submit some questions and we'll save time at the end for these. If you do want to do that, you can use the Q&A button on your screen. So let's kick off with the corporate interest restriction. It's an extremely complex area, which could probably take a whole day by itself. But Jonathan will focus on a couple of key compliance requirements, especially in light of the increased HMRC activity we've been seeing around this. So Jonathan, over to you.
Thank you, Amy, and good morning, everybody. Yes, Amy, you're absolutely right about the complexity of the CIR regime, and it would take a whole day to do it justice. But as you say, we're starting to see quite a lot of HMRC inquiries in this area, particularly when we're doing due diligence on target companies. Quite a few of them are coming up with exposures, and a lot of that is driven by a failure to be sort of properly compliant. So to a certain extent, basic housekeeping. So that's why I picked this out as a sort of hot topic this morning. But it's worth just having a recap because not everybody will be wholly familiar with the corporate interest regime. What we are seeing, of course, is more and more clients and companies finding themselves within these rules. So for some people, for some groups, particularly those who've grown in recent times, this, might all be relatively new stuff. So it's worth checking that you're doing everything correctly. So by way of recap, these rules have been in since 2017, and it was an initiative that was driven by the OECD's BEPS initiative. And in a nutshell, the rules are aimed at preventing UK groups from sort of over-leveraging, from reducing their tax base through excessive use of debt. That's what this is all about. As I say, it's complex, and therefore it was only ever intended to apply to the UK's very largest UK groups. And the sort of gateway, if you like, to make sure only the largest groups were in was a 2 million de minimis level, whereby if one's UK financing costs are below £2 million, then you ought not to have to worry about this. But as I've noted on the slide there's a couple of factors. The de minimis hasn't moved since the regime came in. By my calculations on RPI, I think that would now be equivalent to 2.6 million. But, much more significantly is the fact that interest rates are very, very different to where they were in 2017. And so, we are just finding more and more companies are having to tackle these rules. For any tax folk out there, the sort of bottom bullet point on this slide is just where we find the various law, and it's split into 2 halves. There's all of the sort of computational provisions are in the main bit of the TIOPA Act, and then in one of the schedules there's a whole bunch of stuff on administrative aspects, compliance requirements, deadlines, etc. And as we sort of go on this morning, we'll see that that's actually really sort of quite important now, because that's where we're sort of seeing failings. Okay, so just again, by way of recap, the very sort of basic principles of how the CIR regime works is what we're looking at. We're trying to identify what is the total net financing cost of all the entities within our UK group. And so typically, you need to apply a sort of methodical approach to this. And the first thing to do is identify your group. Normally, that would be very straightforward. It will be the group that, that has your parent company at the top, the group that the UK companies consolidate into. That can be more complex. I know we've got some, people attending who are in real estate businesses and things like that, where we have overseas fund structures, sort of peculiar kinds of entity in Luxembourg and places like this. It can be slightly less straightforward to identify what the top company is, and therefore, what is the group that we need to consider for these purposes. There's just on the second bullet point there, just to note that we're doing our corporate interest restriction after we've taken into account of all of the rest of the plethora of rules that already exist to restrict interest deductibility for UK companies. And then the basic principle is the total amount that we can deduct in any particular year in aggregate for our UK group companies is limited to basically to a percentage of EBITDA. And what we're saying there is, the higher the EBITDA, the higher that allowance then becomes, because, a more profitable business can support a higher level of financing charges. And then the way we get to that is we have this default position where we calculate what's called the fixed ratio amount, which is basically 30% of that EBITDA number. And then there are further restrictions by reference to debt cap, which we'll come on to. And then we sort of compare. So let's assume that one was on the fixed ratio amount for a moment. We take 30% of our EBITDA, an EBITDA that we do just for tax purposes. And then to the extent that our total financing costs in the UK companies exceed that amount, the excess would be disallowed. So that's the sort of basic premise. And then just to sort of reiterate, with that sort of technical jargon coming up here, ANTI is what we call it. That is the sum of our net tax interest expense in our UK group companies. And as I've said, if it's less than 10 million, we don't need to worry about it in terms of a disallowance. We may still want to do some, almost like, if you like, voluntary compliance, because that might help us preserve certain attributes for future accounting periods. And that's kind of one of the thrusts of this morning's sort of discussion, if you like, and we'll pick that up as we go through this. Then, as I said, to the extent we do have a disallowance, we just carry that forward indefinitely, so that, if the business sort of gets more profitable in the future, we might be able to go back and sort of, re-access that interest. Okay, so just taking a slightly deeper dive, so I've already kind of explained the fixed ratio method. As I say, this is the default position. And again, that's important to note, because that will be important when we come to consider our compliance obligations. Because if we've not sort of taken any other sort of affirmative action, then, we'll end up being sort of obligated to take this approach. And as I said, we work out 30% of tax EBITDA. And that's our sort of basic limit for that particular year. Tax EBITDA, by the way, is effectively, it's not the same as accounting EBITDA, because that would be too straightforward, I guess. But it's effectively our profits chargeable to corporation tax, with certain amounts added back to it, most notably interest, because we're trying to get a profit before interest number, and capital allowances. We have to add those back. And capital allowances, being the tax equivalent of depreciation, effectively. And then we're also restricted. You've got to watch out for this one, because everyone tends to fixate on the 30% of tax EBITDA. But actually, we have another limiting factor, which is known as the fixed ratio debt cap. And in a nutshell, that is the net group financing cost. Now, that is not the UK group, that's the kind of global group that we're a member of. And we take those numbers directly from the financial statements. So hopefully, if we're in a group that is doing consolidated financial statements, we just go and get the parent company statutory accounts, wherever the parent company might be located, and we then can sort of lift the numbers out of those to work out what the net group financing cost is. And the only reason we have this sort of additional restriction is to prevent multinational groups from, over gearing the UK business. So by way of example, you could have a multinational group that's funded entirely by equity, so it doesn't really have any third-party debt financing. But then it could introduce sort of shareholder debt, internal debt, to lend down to the UK business, potentially create an advantageous tax outcome by eroding the UK base. So what the rules say, that is not fair. We're not going to give you a deduction in the UK for amounts that actually exceed your consolidated sort of financing cost number. So that's all quite complicated, but it's just really sort of context to remind everybody how this works. I then said that on an elective basis, we can use something different, which is called the group ratio. And we typically see this in a number of scenarios. So what the group ratio method lets us do is, again, by looking at the group financial statements, sort of says, well, actually, if your sort of ratio of sort of genuine third-party financing costs to EBITDA is actually higher than 30%, then, it seems a bit unfair to restrict you to this 30%. And the reason it might be higher than 30% might be because you're in a particular industry, like real estate or infrastructure, where typically, third-party gearing levels are much higher. Or it just might be a situation where you're in an early sort of phase of the business life cycle. You've been able to secure significant third-party funding, but at the moment your profits haven't quite come online, and therefore when you work the maths through, you'll find that as a percentage of EBITDA, your financing costs might be significantly in excess of 30%, in which case we'd probably want to use that number because it gives us a bigger capacity to deduct interest in that particular accounting period. But, and again, this is sort of one of the key takeaways, to do the group ratio method, we need to actually make an election, and we need to make sure that all the admin around that election is correctly done. Otherwise, what we will find ourselves is HMRC sort of rebutting that, and then we revert to the default method, which, as we've sort of just said, in these scenarios could be lower. Okay. So this is the sort of key point that I'd like everybody to sort of take away this morning, or to the extent that you're in the CIR rules. Maybe you've been in them for a while, maybe you're just finding yourself reaching the thresholds for the first time. And that really is around the nomination of reporting company. You need a nominated reporting company to be able to file what we call a corporate interest restriction return. And it's on the corporate interest restriction return that is the place, and that is the only place where we can, for example, make the group ratio election. And what we've seen throughout sort of calendar year 25 is HMRC looking at 2024 CIR filings and not being able to identify that a particular group has ever nominated a reporting company, or indeed has reported the right company, or indeed their facts and circumstances haven't changed such that they ought to have re-nominated. And it's actually been sort of quite bad to get evidence of that a particular group has ever sort of done that properly. Now, it didn't used to be a problem because the revenue got powers to nominate for you outside the normal deadlines, but they did put out a press release, probably 2 years ago now, saying they would no longer do that because sort of groups in their mind were sort of abusing it slightly. And what we've seen them, they've been absolutely true to their word. They've been absolute sort of firm line on this. So you could imagine that if one has a scenario where one had thought you were claiming the group ratio, and let's say the group ratio would come out at 60%, and now because of an administrative error, you can only claim the fixed ratio. So, you know, your allowance, your interest deductibility, it's limited to 30%. i.e. only half as much as under the alternative method, you know, then you've got a problem and you might have a whole bunch of cash tax to pay. You know, it might just restrict the amount of brought forward losses or carry forward losses you have. But in worst case, you know, you might be tax paying for that particular period and suddenly that goes straight to cash tax. You've got a big problem. So just some of the rules on nomination of reporting company. The key deadline that I referred to is 12 months after the period of account. CIR is all framed in periods of account rather than accounting periods, but it's 12 months normally to get that nomination in. And then I guess the only other sort of points to mention are needs to be an active company, but it doesn't have to be the parent company. So a lot of people tend to think, oh, you know, I need to nominate my parent company, but, you know, particularly in overseas groups, you know, where it needs to be a UK member group. But yeah, also single entity groups, you might be a standalone company. If you're a standalone company, that is still technically a group for these purposes. And so you need to kind of nominate yourself. So just sort of bear that point in mind, because there's been a bit of a trap for the unwary in the past. And then, as I say, so the sort of middle bullet point there, we've seen a very hard line, although there was such an avalanche of non-compliant people across the taxpayer community that HMRC wrote to the ICAW and said, actually, we're just going to, you know, for periods ending on or before March 24, we are just going to, you know, not pursue things where there has been an administrative failure around having a defective return because a company was never correct, a reporting company was never correctly nominated. So as I say, if you've not got the reporting company in place, you can't file a CI return, and that's problematic. As I said, I think the main one is not being able to do the group ratio, but there are other benefits, which includes things like you need to be doing a return if you want to carry forward excess capacity from earlier periods. So this could be that situation where you've got very little debt, or less than 2 million, for example, but you do have, you know, tax EBITDA, and therefore you have an interest allowance. If you don't use that particular allowance in a period, that can carry forward 5 years, and that can be sort of beneficial, particularly, you know, if you end up being limited in a future period because of the application of the debt cap, for example. Also, your ability to reactivate any disallowed amounts of interest in a future period, that all needs to be done via return. So yeah, you know, what we're advising clients is, unless you can like 100% categorically prove, and you've got documentary evidence that you have a reporting company in place, then just redo the nomination. HMRC sort of said, you know, just kind of doing a nomination now, or, you know, renominating, is not going to be taken as some kind of like, you know, tacit admittance that there is something wrong for earlier periods. And that's the advice that they're giving as well. Okay. And then finally, just a word on abbreviated returns. So if you've got a disallowance, So, if you exceed the 30% of tax EBITDA in terms of your total financing costs, then you have to file a full interest restriction return. However, let's say you don't have a disallowance, you can still file what we call an abbreviated return. And the reason that one would do that is an abbreviated return can be replaced at any point in the next 5 years with a full return, and therefore preserves the flexibility to be able to, do those beneficial things that we talked about on the previous slide. But the advantage of only doing an abbreviated return now is that you don't have to go through the full time, expense, complexity of doing all of the very detailed calculations which are needed to support the numbers on a full corporate interest restriction return. Um, so yeah, they're the main benefits of abbreviated returns, and I've certainly seen that used to good effect. Particularly, looking after one very large group that was very decentralized. The CIR return deadline is the same time as the corporation tax return deadline. So that puts a massive pressure on the finance function to be able to get all of those returns finalized in time for group tax to then do all of the detailed CIR calculations, for then any disallowances, reactivations, etc., to be pushed back down to the various underlying computations. It can be sort of better just to say, actually, we're pretty happy there's no disallowance, so we'll just put an abbreviated return in now, and we'll do the detailed work in the new year at our leisure. That was it on CIR.
Thanks, Jonathan. We've had a couple of questions in, but we'll save those to the end, and move on to our second topic, which is all around R&D. From the 1st of April last year, the existing R&D relief schemes, which had been around for quite a long time, were merged into one scheme that applies to all companies. Previously, the separate R&D scheme existed for small and medium-sized enterprises, and that resulted in the payment of a generous cash tax credit. So the new rules are likely to be a significant transition for SMEs, both in terms of the quantum of the relief and the way that the scheme operates. So we're just going to take a look at the key features of the new scheme, how similar it is to the previous rules, and again, highlight some important compliance considerations.
Yes, thanks, Amy. I should have taken that moment for a quick sip of water before I go again. Excuse me. Yeah, that's right. So R&D, we've seen significant changes over a steady number of years now, and I think that these are particularly impactful to small and medium-sized enterprises. Certainly, a lot of our clients at Safri fall into that bracket. It's going to be changes for everyone engaged in qualifying R&D, but I just think that for the SME population, this could feel significant. So I just thought it was worth having a recap for everyone's benefit, to just what does the new regime look like, what changes will we see, etc. And so basically the merged scheme has sort of kicked in for accounting periods beginning on or after 1 April 24. So I guess for most of it, obviously we'll have plenty of guests this morning with different year ends, but I suppose nearly everybody who's conducting R&D activity will now be in the new regime. And certainly for some people it would be kind of their first year, because the relevant accounting period will have begun in January 25 for a December year end. And I would say the combined scheme looks more like what we used to refer to as the RDEC scheme, research and development expenditure credit scheme, which is what largely large companies or non-SMEs. That's how they got their relief. And the key feature really is that now whereas particularly for small SME, relief was given in the form of a sort of enhanced deduction for qualifying expenditure. What we will now see for all companies is a 20% above the line tax credit. And so there's a number of reasons why the government likes that. And one of the key ones is it appears above the sort of EBITDA line, and therefore sort of helps raise the importance of R&D in a particular organization. Perhaps better recognizes the contribution of those sort of management personnel who are responsible for innovation within an organization. And the fact that it's coming in above the line means that it does increase EBITDA. So, if you're a company, again, particularly in the SME space, looking to exit at some point, and we're talking about exit multiples, then this is all just sort of good news. In the past, SMEs would typically just recognize the benefit of any R&D credit through the tax line. So that is the sort of first sort of big change, I guess, is that you're going to, how we account for these things it is going to be slightly different, especially in the SME space. Okay. Now, trend we have seen is effectively a reduction in the generosity of the relief available to SMEs. This has been a steady trend. I think HMRC started to get quite concerned about a perceived level of abuse. So there was lots of small boutique companies who were probably, it's fair to say, sailing a bit close to the wind in terms of the nature of basically spurious claims. And I think HMRC put quite a big bill on how much effectively incorrect and probably in some cases fraudulent R&D claims had cost the exchequer. So we've seen that is partly one of the factors sort of driving the reduction in the generosity of relief, and also has driven some compliance requirements, which we'll get onto. So in terms of what relief you'd expect to get, so under the new regime, the net benefit is 15%. That's assuming a company that pays tax at the full rate of corporation tax. And how we get to 15% is, if you remember, I said that the relief is now given by way of a 20% above the line credit. Well, that credit is taxable at 25%, the usual rate of corporation tax. That leaves us with a net benefit of 15%. The 2.2% number that appears in this table, that would be the sort of net rate if actually you're only paying tax at the small companies rate, which is currently 19%. So that's just the difference for the discrepancy in those numbers. And so as you can see, that a profitable making SME is aligned now with a large company. You'll see that whereas previously profitable SME got effective relief of 21.5%, that's now down to 15%. So quite significant reductions. You'll also notice I've not really talked about what we call ERIS, which is basically sort of enhanced regime for companies that are carrying out R&D on an intensive basis. That's sort of quite specialist. We have a team that look after that, but broadly it's like I think we're like your entire cost base is more than sort of 30% dedicated to R&D activity. So there's not really been any changes to that particular regime. I would suspect that if you're within that, you probably already know quite a lot about it. It being the sort of raison d'etre of those particular companies. Okay. Okay. So the key features of the merge regime, where are we still similar with some of the, with the legacy regimes? Well, there's no changes to the definition of R&D for tax purposes. And for those who are interested, there is a government a government publication. It has been amended since March 23, but the original publication goes back to March 23. And there's a very sort of deep guide to what constitutes sort of qualifying activity. And if you've not looked into the availability of R&D for your company previously, I would certainly encourage you to do so, because it is a lot wider. I have a background in pharmaceutical chemistry, so for me, R&D is very much a sort of a white lab coat and stuff like that. But actually, a heck of a lot of the work that is done around IT and systems, qualifies quite a lot of the time. But basically, in a nutshell, we're looking for things that contribute to an advance in science or technology through the resolution of things that were previously sort of technologically uncertain, but you've managed to resolve those uncertainties through the work that you're carrying out. There's quite a complex 7-step computation to working out how much sort of tax credit will be repaid as cash at the end of a particular claim period. So we kind of start off by offsetting our tax liability for the period, which is fair enough. Then any other sort of outstanding taxes of other periods, any other different kind of taxes we might owe to HMRC. There's quite a horrible 7-step sort of waterfall. There's also a cap in there, which is determined by reference to the total PAYE and NIC costs of the staff that we have involved in R&D activity. Now, if you've been a large company claiming RDEC, this will all be sort of relatively familiar. If you're a smaller company, I think this is quite difficult. It's not massively intuitive, I don't think, but you'll see that coming into your tax computation for the first period that you find yourself claiming under the new rules. So it's one to look forward to. And then we've also still got the rules which we've from the SME regime around being able to contract R&D out. And we're restricted. This is already in the old SME rules, where we contract costs out rather than do them with our own staff. There's a restriction of 65%. So that's all sort of stuff that is broadly familiar from what either of the sort of legacy regimes. And we look at a couple of changes. Okay, so this significant one is now we can't really claim for amounts that are paid to contractors or externally provided workers who are based outside the UK. Now that really just puts us on a par with, with most other kind of sensible economies. And if you think about it, it makes sense really, because, one of the policy objectives is to, develop a more sort of knowledge-based economy. So that's just a policy thing. There are certain exceptions to that rule, but they're pretty niche, so I think we need to cover those. Another sort of significant thing is where you're sort of subcontracting your R&D activity. So let's say you've got let's say you've got a small company doing some work on behalf of a big pharma company or something like that. In the past, it was always the small company that was entitled to the relief, or in lots of cases anyway. Now there is a whole bunch of rules and fairly extensive guidance who actually now tell you who should be entitled to the relief. So that will somewhat change the economics of things. So if that is your commercial fact pattern, that you say, I don't know, you might be a small entity doing something for a larger company, you probably want to look at that and the contracts and understand the new rules and check that you're not going to sort of, effectively the relief be reallocated effectively to the customer in these cases. And then just as the slide notes, there's certain instances where it's just actually deemed to be the contractor who qualifies because the customer, if for example they're a charity, certain educational institutes, they're not allowed to claim. So it means that somebody is still entitled to the relief, which is good. Final point there used to be restriction on subsidised R&D expenditure. So in the past, if you found yourself stymied from claiming because you're actually being subsidised, then it might be worth just to revisit that. Important compliance aspects. So there's basically two things, and these can really catch people out. And it's, again, the context to this was the sort of perceived abuse. So now we've had this isn't necessarily a feature of the merge regime because these rules have been in for a couple of accounting periods now. But basically, it's two things you need to do. If you've not claimed before or you've not claimed recently, you need to make a claim notification requirement. So you need to put HMRC on notice that you're going to be making a claim in respect of a particular accounting period. Now, this is quite a nasty one because the deadline is 6 months after the end of the relevant period of account. Now, what a lot of people know is quite often we don't get round to doing, rightly or wrongly, we might not be organised, we don't get round to doing the compliance work or really thinking about the detailed sort of tax return position until significantly after the year end. And so it really can happen where actually suddenly the tax folk come in, start to look at all of this, and the deadline has already gone. So you've really got to watch out for that one. And then the other important bit of compliance is something that they call the additional information form. Now, this is something that has to go in sort of on or just before the time that the tax return that includes the claim is filed. So typically that will be 12 months after the end of the accounting period, but could be longer. And that's quite a detailed submission that contains quite a lot of technical information, narrative as to, what projects has the company been doing, what were the technological or scientific uncertainties that the work was trying to resolve, so typically needs the input of the sort of engineering or science or IT folk from within the business to sort of help populate that. And then to the extent we default on either of these compliance aspects, then HMRC can just take the R&D claim back out of the tax return. And we've seen that happen, not on our own clients, I hasten to add, but it's a very sort of real thing. And again, they're playing hardball with that. Another sort of practical tip, quite often, or it's not infrequent, that you might use a different provider to do your R&D work as compared with the person that's responsible for filing your tax return. In those instances, you sort of need to be really clear which firm is taking responsibility for each of those compliance aspects. What the extent of the firm that is submitting the tax returns sort of responsibilities are, where that R&D is coming from a sort of different third-party provider. That was it on compliance.
Thanks, Jonathan. I'll try and speak slightly more slowly this time so you've got time to take a sip of water. The final session that we've got this morning, Jonathan's going to look at some of the supplementary pages of the corporation tax return that require companies to identify transactions that fall within the hybrid mismatch rules. So again, quite a tricky area, and one that we're seeing HMRC taking a look at more frequently now. So Jonathan, last session over to you.
Thank you, Amy. Yeah, thanks for that. And I'm going to sort of speak through hybrids fairly quickly, because if CIR would take 1 day, this would take 2 days to go through hybrids in its entirety. But again, it's sort of driven by some of the activity we're seeing in terms of HMRC inquiry, where they are asking to look at group structures and sort of understand to what extent the taxpayer has done sufficient work to adequately make a reasonable self-assessment of where they sit vis-a-vis the hybrid rules. I'm sort of conscious that these aren't going to be relevant to everybody on the call. That's why it's a really sort of very brief reminder. They're basically, the hybrid mismatch rules also came in 17, and they're designed basically to counteract tax advantages that arise because of the different treatment of either an entity or a financial instrument in different jurisdictions. And what that leads to is sort of expenses being recognised in one particular jurisdiction, but the corresponding income not being recognised in the other jurisdiction. That's the sort of crux of the mischief, and that was the core. I've done international tax planning for sort of, I don't know, 28 years, something like that, and this is what we did. And the OECD and BEPS came in and said, no, we can't do that anymore. And then what resulted was the sort of very complex hybrid regime. Now, if you're sort of an attendee today and you're thinking, well, might these rules apply to me? The two most common scenarios where I've had to contend with them, and it's probably the same for most people, is where we are a portfolio company that is owned by private equity. So quite often up the private equity ownership structure, there will be problematic hybridity going on. Or if we're just a member of a US group. So the US groups are very fond of what we're doing, check the box elections. And what check the box election means that they will, in respect of certain subsidiaries, they will choose to treat them as just not regarded. So sort of flow through or transparent for US tax purposes. But in the UK, we will continue to respect them as corporate entities, as companies, and absent this hybrid mismatch regime, that can lead to one-sided tax outcomes, which we used to exploit. So that's the context to this. And here are the key pages, which I've just sort of reproduced here. So this is a supplementary page to the regular CT 600, which is your corporation tax return. So it's the CT 600B, and for those of you with sharper eyesight than me, well, it's kind of all right because I know what it says. We'll see this kind of 10 questions around hybrids. And all taxpayers, to the extent these questions are relevant, need to sort of go through and complete these. And we're just finding that perhaps, particularly in sort of smaller, less sophisticated groups, which could still have complex ownership structures, but perhaps people without in-house tax function, this is very complicated, and this is actually quite difficult to answer potentially, because there's a whole bunch of phrases there. What does any of that even mean? And we're finding that in a lot of cases this just gets ignored to a certain extent. So this really is a sort of call to action, that if you're not sort of currently doing a reasonable amount of work on this, and but feel you ought to because of your ownership structure, maybe now is the time to have a look at it a bit more closely. Into the next page. So that's just really a summary of what's on those boxes. But I would say, if HMRC come in and audit you as to how you've completed these boxes, if they are sort of relevant, I would say the sort of main thing is, do you have on file the documentation to show that actually, you have done a degree of review and why you have reached the conclusion that no adjustments are needed under the hybrid regime. Effectively documenting that you've sort of acted reasonably in making that particular self-assessment. The key point, it's maybe the first sub-bullet point, you do need an understanding of the structure outside of the UK. And that could be like the structure of the group, coming back to my US group example, or it could be your investors structure, coming back to my private equity example. And they're not like exhaustive, by the way. There's hundreds of other scenarios where we could have a hybrid situation. They're just, in my experience, the most common. So it can be problematic getting that information. Fine if you've got like a group tax function who you could just go to and give you that information. That might be the case in sort of for a US LLC. For US, multinational, they'll be able to tell you who's been checked as transparent and all this kind of stuff. But actually, if you've got a private equity fund, they could well not be in a position to share that information with you. So in fact, I've just got that example to close on this morning because we're kind of at time. But as this one comes up, if we just go on to the final slide, this is one that I've seen quite a lot because we have a lot of kind of mid-market private equity owned clients, and this would be a sort of simplified version of a sort of common structure. And what we have here is there'll be a certain amount of the fund's acquisition debt will have been, acquisition equity will have been advanced as interest-bearing debt. In my example, we'll be paying interest from a UK topco. Well, it could be from bidco, where it doesn't matter. So we take a deduction for the interest in topco, and we group relieve that against our UK profits. Now, a fund limited partnership is pretty much treated as transparent wherever it is for tax purposes. So that interest income just flows through the partnership. So then we have to say, well, how are the investors being taxed on that income? Well, if we've got no sort of corporate investors, then it seems fine because they will be sort of paying tax on their proportional share of the partnership profits. However, if we have a load of other transparent investors, potentially in things like Cayman vehicles, BVI vehicles, who knows where, quite common in private equity funds. We just have no view on that. And the fund manager can't really tell us because, typically the limited partnership agreement that sets out how that partnership is run, will not, they will not be able to, there'll be confidential information. They won't be able to share that with you. So I've seen quite often in working out how much interest we deduct in the UK group, or in Topco in the way it's drawn on this slide, you almost just have to go through and say, of all the investors, who is definitely not causing us a problem because they're a US Inc. or they're a US fully taxable individual or whatever, and then say, well, actually, we can say for sure 72% of investors are fine. Therefore, we're just going to take it on the chin and assume that for the other 28%, we have a hybrid mismatch. In reality, the number will be less than that. We've taken the worst case position and we'll disallow a proportional amount of interest accordingly. And then, of course, overall, it might not really matter because we might still be getting caught by CIR. But, that's another story. So that's it for me. Three hot topics that we're seeing a lot of in practice. And I hope that was helpful and hope people have got some questions. But back to Amy.
Thanks, Jonathan. Yeah, we definitely have some questions. So thanks everyone for submitting those. And I'm sure everyone found all those practical tips, Jonathan, really helpful. Let's start with some of the CIR questions. One that's come in: how are groups managing the increased complexity and compliance burden, especially now more companies are falling within the CIR rules given the interest rate and inflation changes?
Well, I think, first of all, needs to sort of be recognised that more resource is required, and so that has to be sort of taken into account in your planning and your compliance timeline. But in a lot of cases, people are outsourcing it to people like ourselves, and you can see, if you don't want to sort of outsource permanently, what I have done for clients in the past is you sort of see, you maybe get them set up in the first year, and develop a bit of a sort of model, if you like, for how we're sort of capturing all of the necessary data. For a lot of clients in the past, where they do their compliance in-house, they might ask us just to sort of specifically review the CIR work, just to get a second set of eyes on it, a second opinion. I reckon I'm the sort of firm's champion for this, as you know, Amy, and I reckon more often than not things need adjusting.
Yeah. Okay, staying with the CIR theme then, we had another couple of questions. Does the interest limitation apply to private equity instruments as well as conventional debt?
It does. So the definition of interest is very, very broad. It's kind of all financing costs, really. It's pretty much everything. For the more techie tax folk on the call, it's pretty much everything that falls under the non-trade, or rather necessarily non-trading, under the loan relationship code. So it's a broad church. That's with the exception of sort of foreign exchange movements. But what you find is that, yes, the private interest on private equity shareholder debt, that comes into all of our calculations. And that also is kind of good debt for determining our fixed ratio debt cap. So that kind of 30% method, the default method we talked about. Then the private equity debt, we're saying that that's good. That counts as group debt for these purposes when determining what that limit is. But we wouldn't take into account in working out our group ratio, because it's the related party.
Yeah. Okay. And again, on CIR, what happens if you do a group restructure, hive up all the assets out of the nominated company? Can you also move the carry forward allowances out of the nominated company?
No. So, can I elaborate? No, I mean, that's tricky. So 3 points on that. One, capacity remains a group attribute. So that's all about which was the sort of top company of a particular group. And capacity doesn't get reported on any particular tax return, just kind of sits on the group return. And then disallowed interest that we might want to reactivate, that becomes an attribute of the company that you disallowed the interest in. And so that's one of the important facets of the return, because the return gives you the ability to choose which company you want to take the disallowances forward, which could be important if you know you're going to sell an entity, you might not want to put the disallowed interest in it, because you might want to keep that. So it's an attribute of your retained group going forward. There's a little bit of strategy around that. And then the other thing just to watch out for, because I don't think I covered it, I skipped over that slide, but you've got to be really careful if your parent company changes, because that requires you to effectively not renominate or nominate a new reporting company, even if you want that company to be the same as it was under the old structure. So there's a few things to watch out for there.
Yeah. Okay. On hybrids, do the hybrid rules apply to a PE fund with an Isle of Man LP?
Quite possibly, yeah.
Yeah. And under the rules, is there a particular percentage ownership level required, or does it apply to all instances?
So for a lot of the rules, we talk about control groups. So for a lot of the rules, you're only in them if you're in a control group, or if it's like with a third party, but you've kind of conspired to do something exotic from a tax perspective. The thing with the private equity scenario is, even where individual investors, so going back to that little example I put up, might own a small percentage, they're all kind of because they're sort of acting in partnership, they're all deemed to have the same interests in the business as all the other partners. So you sort of aggregate it all. So yes, in a regular group scenario, just if we had like a sort of minority investor, they probably wouldn't be in the control group, and we could probably ignore transactions between our UK taxpayer and that kind of entity. But if they're like all connected through a partnership structure because they're PE investors or something like that, then that's normally a problem.
Yeah.
Or not
Okay.
problem. It normally brings us within scope.
Mm. Okay. Um, and a slightly broader question on R&D. Do you think there'll be any further changes to R&D in this autumn's budget?
I don't think so. I mean, obviously, state of the nation, who knows? But I think, as I sort of showed on the slide, the trend, particularly for the SME space, we've already taken quite a lot of value out of the R&D regime. So, I think they've kind of taken it away already. But I can't see, given I can't see suddenly changing the numbers to make it more generous, given everything else that's going on. And also, it was kind of key feature of the sort of corporate tax roadmap when the government came to power. And it's almost like they've implemented their changes to that now, so they can kind of, that work is done, and we're only just into this new merged regime, really. So I would expect them to leave it alone this time. Maybe some minor stuff around, the costs that qualify,
Mm.
perhaps, that nothing major, but that's just a view.
Yeah.
I don't
Thanks.
have any special insight. Which
No, we don't, do we? Okay, just conscious of the time, and want to make sure that we have time to thank everyone and wrap things up. So we'll leave the questions there. Thanks to everyone who submitted them. As I think you probably saw at the start on the slide, you'll receive an email with a link to the recording of the session in case you want to refer back to it. We have got more webinars to come. Our next one in the series is on employment taxes, and that will be on the 4th of December. So do look out for that. And the only thing left to say before we close the webinar today is a big thank you to Jonathan, and a big thank you to all of you for attending. I hope you can join the next one. So thanks from us and goodbye.
Yeah, thanks everybody. Bye.